Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at whether New Zealand should have a bank deposit insurance scheme, just like in other countries. And we'll look at the latest on housing prices and official interest rates, where some are now calling on the Reserve Bank to cut rates. We'll explain why they're wasting their time. But firstly, we look at whether New Zealand should have a bank deposit insurance scheme. Most people here don't give much thought to whether they might lose their money if they put it in the bank. Surely the bank is safe. We haven't had a bank collapse here in living memory, and most believe that surely someone would step in to stop a bank from collapsing. Well, actually, there are no formal guarantees about the safety of your bank deposits. Aside from the shareholders at the big four Australian banks, we have no guarantees. Now, the assumption is, of course, that the government would bail out one of these banks if they got into trouble. But that's only an assumption, and it's a big one at that. New Zealand is unusual in that it doesn't have a deposit insurance scheme. Britain has one now after the near collapse of Northern Rock. The United States has had one for a long time. Even Zimbabwe has one. The Reserve Bank has argued that a deposit insurance scheme raises a so-called moral hazard risk. It says bank managers might lend willy-nilly if they knew their depositors were safe, or that depositors wouldn't bother to check out their bank if they knew it was insured. I believe that argument is flawed. No one is checking out the bank now. If I can find someone with a bank account who's read the bank's general disclosure statement, other than me of course, then I'll eat my bank statement. And the idea that bank managers would operate more riskily with deposit insurance is tenuous at best. We need a deposit insurance scheme for, say, the first $50,000 or $100,000. These are nervous times, and anything that prevents a run on a good bank is a good idea. Now for a quick look at what the Treasury is saying about the housing market. It is warned that it is slowing down much faster than it previously expected. Treasury says higher retail mortgage interest rates and lower net migration are to blame for a slowdown that could push down prices this year. Treasury is not the first to say this. The Reserve Bank said last week it saw house prices as 20 to 30% overvalued and that prices could fall 5% this year. Now we have some banks calling for the Reserve Bank to cut official interest rates to boost the economy. The ANZ has suggested things are slowing quickly and the central bank should act now. Even Mark Weldon, the boss of the NZX, is saying there should be a rate cut. There's a couple of problems with this. New Zealand still has an inflation problem, and the Reserve Bank needs to beat that. And secondly, any cut in the official cash rate would be a waste of time for consumers in particular. That's because fixed mortgage rates, which cover about 90% of homeowners, are based on wholesale market rates, and those rates are, if anything, rising right now because of turmoil on global financial markets. New Zealanders will just have to deal with higher interest rates. It may mean house prices will fall and the economy will slow. But really, that's the price we all have to pay for going on a 5-year-long debt-fueled consumption and house buying binge. It's time for the hangover, and no amount of Barocca from the Reserve Bank is going to fix it. I'm Bernard Hickey from interest.co.nz with the daily briefing. Catch you on Wednesday.